Hello and welcome to Wall Street Vision, a show that explores investment ideas from the best investors in history. I'm your host, Vlad. This podcast is for informational purposes only and should not be relied upon as the basis for investment decisions. I may maintain positions in the securities discussed on this podcast. What's up, Vision Nation? Thanks for joining me for this week's episode. This week, we're going to discuss inflation and taking some lessons from Warren Buffett on how to deal with inflation from an investing perspective. But first, I want to start with a story about what inflation looks like in an extreme scenario. I'm talking about hyperinflation. Now, I want to start off by saying that I don't think we're facing a hyperinflationary environment, but I think you'll find the story very interesting. So let me dive right into the story of the German money printer. By the way, for the history buffs out there, this story is really about the Weimar Republic, but I'll just refer to it as Germany to keep it simple. Everyone knows that war is super expensive, and when it comes to war, there's two options that a country has. It can pay for the war by increasing taxes from its citizens, or a country can borrow like crazy. Germany chose the borrowing approach in World War I. They were pretty confident in their ability to win, so they figured that they'll win the war and then get the losing countries to pay reparations. War reparations are the payments that the loser pays to the winner after the war is over. That's only fair. If you lose, you get the shame of defeat, and you have to pay the winner for repairs to all the cities that you've bombed. It was a good plan until Germany lost, so their plan got screwed. Essentially, they lost the war and had all this debt to pay back within their own country, as well as all the money they had to pay back to the Allied forces for war reparations. Germany started paying off their debts with the gold they had left over. After the gold ran out, Germany still had lots of debts to pay back. The German currency at the time was the paper mark. So they printed a ton of paper marks to pay back the reparations to the countries that won the war. Now, printing all these paper marks devalued their currency a lot. It's the old economic situation where something that is abundant is not going to be worth much. All of a sudden, there were all these paper marks floating around, so each individual paper mark was worth a lot less. The cost of living increased by 17 times in 6 months. Can you imagine if a Big Mac went from costing $5 to $85 in 6 months? That's crazy, right? So if you're living in Germany back in those days and you see that your money is becoming worthless quickly, what do? You go out and try to spend it as soon as possible because that way you'll get the most goods for your money. Now, what happens when all of a sudden demand goes through the roof? Prices go up like crazy. And that created this vicious cycle where prices went up, so people rushed to buy things, which caused demand to increase, which caused prices to increase even more. On top of that, you had the German central bank printing tons of currency as well, so it was a huge mess. At the peak of this madness, prices doubled every 4 days. A newspaper that was worth 1 mark went up in price to 70 million marks in a span of a year and a half. The currency got so devalued that, picture this, people would get their work salaries calculated by using a scale. They'd literally dump the cash on a scale because counting it all would take too long. It got to the point where it was cheaper to burn paper marks instead of using wood to heat up your home. Like, it was literally cheaper to take a suitcase full of cash and throw it into your fireplace for warmth instead of using coal or wood. Eventually, the situation stabilized, but you can imagine the pain that people went through there. People who were saving diligently for a rainy day all of a sudden had their savings become worthless. Really sad stuff. Now, I started with that extreme story because it's fascinating. I don't think we're in this type of environment right now, and I don't think that this is where the US or Canada is heading, but there's no doubt that printing tons of currency is a very risky thing for a country to do. So that story illustrates inflation at an extreme level. Most developed countries today are nowhere close to that, but inflation has definitely ticked up in the aftermath of COVID. As an example, copper, food, and lumber prices have gone up quite a bit recently. I want to go over Warren Buffett's thoughts on investing in an inflationary environment, but before I get into that, let's take a step back. What is inflation and what causes it? Inflation is when you lose purchasing power over time. Imagine your grandfather telling you that back in his day he would get a 3-course meal for $2. The reason you can't get a 3-course meal for $2 today is because of inflation. Now, inflation is not all bad. A certain amount of inflation is good because it encourages people to spend money now. If you know that in 10 years your $1,000 is going to be worth half of what it's worth today, it's a good incentive to do something productive with that money instead of stashing it in a mattress or putting it in a savings account at the bank. So inflation encourages people to spend or invest, which fuels the economy. Too little inflation means people don't have an incentive to spend money, which can have a bad effect on the economy. Too much inflation is bad because it causes a lot of economic uncertainty and penalizes lenders. A simple example is if I borrow $100 from you and inflation is 20%. Even if I pay you back $105 with interest, you've still lost your purchasing power for being a lender. A high rate of inflation also hurts people holding cash because their cash just consistently gets devalued. So inflation is bad for lenders, but it does help borrowers. Let's carry on with the example where I borrow $100 from you and inflation is 20%. This is good for me because if there's a high level of inflation in the economy, many prices will rise and wages will probably rise too. My income will probably increase, and that will make it easier for me to pay you back. Think of the extreme example of Germany after World War I. If I borrowed 500,000 marks to buy a house and then hyperinflation hit, and all of a sudden I was making 500,000 marks per day, it would be easy for me to pay that mortgage off in a single day of work. So generally, inflation hurts lenders, but it benefits borrowers. That's why inflation hurts people that hold bonds, because when you're holding a bond, you're essentially a lender. It's one of the reasons that Warren Buffett doesn't like holding bonds, especially if inflation is on the horizon. I don't want to get too technical on the terms here, but there's 3 types of inflation. I'm going to go over them quickly because I think it's helpful to understand the different things that can be happening to cause inflation. The first type of inflation is called demand pull inflation. This happens when there's not enough supply to meet demand, so people are willing to pay higher prices to buy products. A simple example is exercise equipment during the pandemic. There were times when you couldn't buy weights, so companies that were selling exercise equipment could raise prices and still sell all their inventory. Since demand was high, prices increased. Cost push inflation is the second type of inflation. This is when the cost of a material increases, and that causes an increase in the price for the finished product. The cost of lumber in North America has gone up quite a lot over the past year. Let's say you're paying someone to build a deck in your backyard. Since lumber is more expensive, the cost of the deck will be more expensive as well. So any industry that uses lumber will have increased prices. The third type of inflation is built-in inflation. This one is more theoretical. If the overall cost of living increases, people will expect their salaries or wages to increase to help maintain their living costs. Of course, once salaries increase, that means that costs of products or services will increase because companies want to make the same margins, so they have to charge more for their products. So this causes the cycle to go on and on. That covers the 3 types of inflation. In terms of where we are today, Charlie Munger did this interview in December 2020, and he said that we're in uncharted waters. Governments are spending like crazy, interest rates are low, and the pandemic makes it a lot harder for either of those to change because governments want to do what they can to help with the recovery. So I took a look through previous interviews with Warren Buffett to figure out how he dealt with inflation from an investing standpoint. Warren Buffett has seen 2 periods of high inflation. Inflation in the US was around 11% in 1974, and it was over 13% in 1980. By comparison, inflation today is around 2 to 3%. Warren says that it's great if you have a unique skill set, like if you're a great teacher, a great salesperson, or you're a lawyer or a doctor. You would have already paid for your degree or training in real dollars, and the skills that you learn, well, you can then charge inflationary dollars for those skills. So a great salesperson will make a 5% commission, and if there's crazy inflation happening, they'll still make their 5%, so they'll earn more inflationary dollars. So as a practical guide, Warren Buffett says to always keep increasing your earning power by having specialized skills. Now, in terms of investing, he said the best business to own is one where you can maintain the earnings in real dollars without having to reinvest into that business. So businesses that don't require big capital expenditures are great in inflationary environments. Let's go over two examples. One of a business that's bad to own during inflation, and a second business that's good to own. Warren gave the example of airlines being a poor business during inflationary times, especially if they need to replace their fleet of airplanes. Because the airlines have to reinvest into new airplanes, and those planes will cost a lot in inflationary dollars, that will eat away at the returns for investors. Essentially, the airline would have a big cost that they have to pay in inflationary dollars. That would be really hard to pass on to the consumer if the cost is massive. So if you think there's high inflation in the pipeline, you'd want to avoid businesses that have a big looming capital expense coming up. For an example of a good business to own during inflationary periods, let's take a look at See's Candies. We've covered the See's Candy story in episode 8, but today I'll look at it from an inflation perspective. Warren Buffett bought the See's Candies chain of stores in 1972, and inflation was around 11% 2 years later. See's didn't have any big capital expenditures coming up, which was a really positive thing. Their biggest expenses were raw ingredients going into the candies, rent for facilities, and labor. They didn't have to buy big new machinery or replace a factory or anything like that. Also, the cost of candy is relatively low when you look at a person's overall budget, and See's Candies are mostly given as gifts. So even if the raw ingredients like sugar, cocoa, and butter go up in price, See's was able to pass on the extra costs to the consumer, and sales volumes didn't go down. Warren Buffett likes businesses that are recurring purchases, that people will keep buying even if there's inflation happening in the marketplace. See's Candies didn't have any huge looming expenses that they had to make in inflationary dollars, so in the 1970s that was a great business to have during the high inflation years. You'll often hear people say that gold or commodities are good inflation hedges. In last week's episode, we talked about how Warren Buffett is not a fan of investing in non-productive assets like gold. So his perspective is that it's way better to invest in a productive asset like a See's Candy type of business instead of buying gold or commodities. One thing I want to mention is that when you see headlines, you'll often see that inflation is 3 or 4% or something like that, but that's just the overall picture. Most times inflation happens in certain areas that are more affected than others. Some people think that inflation affects everything by the same percentage, so your food, car costs, rent, and so on will increase by the same amount, but inflation can come through in certain pockets. Here are some rough numbers. For example, between 2009 and 2018, the main inflation index went up by 15% in total. So that's the sum of all the inflation that gets tracked, and that's the headline number that you'd see in a newspaper. At the same time, college costs and healthcare spending increased around 30%, and housing in some areas went up by 50%. So inflation is not evenly spread out at all. It can affect certain industries or assets much more. To summarize, it looks like inflation will increase in the near term. If you think that's the case, then Warren Buffett's perspective is to avoid bonds and holding cash, and to hold businesses that don't have large capital expenditures coming up. That wraps it up for this week's episode. Thanks so much for joining me, and I hope you have a great day.